Good morning, everyone. Thank you for being here. I know this is a difficult day, being the third day of the conference, and plus the fact that we have some seminars running upstairs. We have parallel sessions, 3 parallel sessions. We have our keynote speaker for the day, Professor Geoffrey Woods, Dean of Essex Business School, that he will give the keynote address for this morning's session. So, Jeff, the floor is yours.
Good morning. I became interested in the issue of long energy transitions to really try and understand a problem. And that is, since the early 1970s, the global economy hasn't been in great shape. It's been unpredictable, periodic periods of recession, even depression, and most recently, which is unpredictable, some of the most advanced economies have ended up in open-ended political crisis. So what does this all mean? Well, the last time we saw such a period of global uncertainty was from about 1900 to 1945. Now, people tend to see it well as all sorts of things. Piketty talks about rentiers, all these things. However, it misses the basic structural point. The first part of the 20th century was a long energy transition from coal to oil and gas. And what we know about long energy transitions is it fundamentally changes the competitiveness of countries, regions. It requires the reallocation of capital. And indeed, those who can move the capital around are at an advantageous position. Now, that seems all very general. However, if you look, you'll notice that in that period, generally speaking, more coordinated economies faced huge existential challenges. Liberal markets, like Britain and the States, did relatively well out of that period. Obviously, the crisis was global, but in the end, Britain and the States and the other liberal markets retained political stability. They never had the major collapse you saw in many of the more coordinated economies. Why was this? Well, a couple of reasons. The one is, and you have to take an even longer point of view for this. People in Greece are very aware that the Italian Renaissance was largely paid for by the looting of Constantinople, by the Crusaders, we know that. Now, the interesting thing about the liberal markets, they have one feature which shapes corporate law. At a key moment, they got a lot of capital for free. If you go back to the 19th century, Britain had the empire, the slave trade, the looting of India. Now, economic historians can argue about which of these points was more important, but effectively, they got a lot of capital for free. The US expanded westward, again, dispossessing Native Americans, a lot of capital for free. The same is true for Australia, to an extent, Canada and New Zealand. So, lots of free capital. So the challenge wasn't so much about generating capital, it was about legitimizing and allocating it. In contrast, obviously, inward market coordination is quite difficult. And precisely because they didn't have that legacy of mobile and injected capital, coordinated markets coped quite badly. And indeed, as you all know, Germany and Japan experimented with alternative in the 1930s. So how does this take us to our present condition? Well, once again, since the early 1970s, oil and gas prices have not been predictable, historical terms more expensive generally, uncertainty, and as we know, we're in a long energy transition now. Now, at first this might seem that once again, it's people who can move their capital around who are most likely to profit from the situation. And indeed, there was a period in the 1990s when it seemed the liberal markets were actually doing better. However, since then, the tables have been somewhat turned. And the reason why it's different are a number of reasons. First is it's not the same as the rentiers in the 1930s. You certainly have mobile capital that's very much like rentiers, but some of the mobile capital these days is very different kinds of investors like national sovereign wealth funds. Some of the most biggest sources of movable capital are actually national governments. The Norwegian government alone owns 1.5% of all shares in the world. So it's very, very, very significant. The second is alternative energy. Intrinsically, you're talking about longer investment horizons. Obviously, in the short term, there is uncertainty imparted by the vagaries of government policy. But as subsidies taper off, as sources like wind and solar can increasingly compete without subsidies, it is very much clearer that intrinsically it favors more patient, longer-term investors. Now, this sounds all very good, it's always good to have big ideas. Now, in practice, what happened then was I persuaded two major journals, Journal of International Business Studies and British Journal of Management, to run a joint special issue. And we're quite selective. We got empirical papers from around the world. We were quite selective. Now, what was interesting is, although people came from different backgrounds, finance, economics, strategy, international business, all the papers basically reached the same broad conclusion. Coordinated markets were much stronger when it came to the adoption of renewables. Liberal markets were very much looking backwards, hanging on to oil and gas. And this was a very interesting phenomenon, that there was this very clear body of evidence. But this, at the same time, like all these issues, okay, so it's nice to be proven right sometimes. We all like that. However, there's more to the point, why was this happening? And so at this stage, I talked another journal into having a special forum of papers where people could come together and debate as to why the causes. Now, again, we got people from all over, and yet, oddly enough, all the papers pointed to some of the same broad phenomena. The first is for a very complicated range of reasons. Liberal markets favor the environment, the ecosystem of oil and gas. Now, this is partially because of the nature of electoral systems. Typically in liberal markets, it's first past the post, which means you have a few marginal seats that determine elections. And this makes it very much easier for vested interests to affect election campaigns. And we all know this is it's quite widely documented, particularly in Britain and the States, that you can swing elections relatively easy by targeted vested interest campaigns. The second is the nature of elite formation. What's wonderful about this event is it brings together people from practice, government, academia. It's difficult to conceive of this event taking place in the UK. In the UK, there's a lot of distrust for intellectuals. Instead, the dominant elite within government, within policy, tends to be either people from the financial sector, and indeed people linked to the military defense industry, are very, very extremely powerful. So you have certain different kinds of elite formation. So the second thing is the nature of elite formation. The third thing is the nature of capital. Because not just have you had a history of a highly mobile capital, and one thing we know about the oil and gas industry, it has become over the years a lot more financialized, a lot more speculative. Nobody knows still, you would think after all this time, where you can actually make money out of fracking other than by leveraging debt. Nobody's yet made money out of it other than by leveraging debt. And this is relatively, no little concern. So there's certainly a great deal of issues going on there. But how does this, again, it raises a further question. How does this relate to the fact that Britain and the States, which is not supposed to happen, relatively mature democracies, both have ended up with open-ended political crisis? How does that happen? How does that fit together? Well, and again, this is something that's puzzled me a bit, and it's something one is working on. And obviously, systems are never closely coupled. It's not like a sort of single functioning machine. But at the same time, and by the same measure, it's evident that with Britain and the States, one of the big problems is for most people, the system is not working. Most people, it's getting poorer. And this is quite interesting because, of course, a completely different example. If you go to China in the early 1990s, when the Chinese government were trying to decide what to do after the fall of the Berlin Wall, they reached a conclusion. If you have broad-based growth, a lot of your political problems go away. And one of the problems with Britain and the States is growth is not broad-based. Intrinsically, each time you've had the last two recessions you ever had, whether the recession or depression, each time a large chunk of regular jobs went and never came back. So though there's employment, it's insecure employment increasingly. Each time you took a big chunk of decent jobs out. And with this becomes political problems. How does this relate to renewables, oil and gas? Well, essentially, it is ultimately about time horizons, investor behavior, lack of investor commitment. And this, again, ultimately makes things extremely unpredictable. Two other points. The first is a bit of a research agenda point. Business and management scholars tend to look at organizations. People in corp finance tend to look at, investors and how firms do. But there's another area, obviously, looking at issues like asset pricing, monetary policy. And we need to integrate these different forms of analysis. Because for example, and again, there is quite a lot of empirical evidence to support that. In Britain and the States, one of the consequences of quantitative easing has been investors are becoming less and less discerning. We know the types of investment, which are volatile, but also perform badly, but they still attract capital. It's very much the phenomenon, you might say, is a bit like the Zimbabwe Stock Exchange. Under the worst days of Mugabe, was actually doing very well, because, people had to put the money somewhere. And so you've had, as a result, the rise of less discerning capital. The other structural phenomenon as well for this, the decline of the listed firm. And indeed, again, brings us back to sovereign wealth funds. Probably between them, the big sovereign wealth funds now own something like 8% of all shares in the world, maybe more. That leaves only 92% of shares for everybody else. Again, you have to put your money somewhere. Now, on one hand, it's nice to see patterns and interlinked events coming together around broad historical processes. And yet with this also becomes elements of unpredictability. If you speak to any informed political scientists, they will say to you, well, there is a possibility, like the UK could end up with an authoritarian government, and the reasons for that. We don't know what it's like to have a major liberal market entering a sort of post-democratic era. With global warming, it's quite likely we'll have to move at least one megacity. Nobody knows what it's like. Nobody's ever moved a megacity yet, with all the jobs, with all the industry, with all the firms. So, although clear patterns are emerging, there's a strong element of unpredictability about proceedings. You recall that the last long energy transition culminated in war and quite major rebuilding then. The liberal markets have not had to stage a major redesign for a couple of 100 years. And ultimately, major institutional redesign is a very uncertain business. Thank you.
Thank you very much, Jeff. I'm sure that our next speaker will pick up of a few words that you've said there about the ownership of shares from, mostly oil-dominated kind of state funds, I guess. It can be linked to your speech, but you will see that our next speaker, keynote speaker for the day, is Mamadou Abu Sarr. He is a Senior Vice President and Global Head of Environmental, Social and Responsibility for Northern Trust. He flew in from Chicago for this event just for the day, and we thank him very much for that. Mamadou, I will give the floor to you immediately, and then we can have a very brief Q&A with Jeff in the panel. Thank you.
Good morning. I'm probably a bit jet lagged, so if you see a bit of a slow tone, it's probably based on the fact that I flew in from Chicago just yesterday and trying to get to the time zone, and I'm flying in about 2 hours from now, right? So what I would like to do is kind of complement the picture of what you heard over the past 2 days, actually arguably now coming to the third day, around the role of finance and how the financial world can also play a critical role in that broader transition to a low-carbon economy. So in the next few minutes, I'll kind of walk you through the landscape, what we see in the field, the type of investment strategies, but also what we do in my own firm, Northern Trust Asset Management, where I'm headquartered in Chicago. So without further ado, let's get into the details. And without doing too much of an infomercial, I'll kind of briefly mention the role of Northern Trust in that broader ecosystem. So if you think about the world of finance, asset management represents a major portion of the assets that are professionally managed around the world. Today, you have around $80 trillion of assets that are entrusted by investors and managed by the likes of Northern Trust, BlackRock, or State Street, or all the large asset managers such as Amundi and others. So ultimately, the role of an asset manager is to make sure that you are compensated for the risk you're taking by getting exposure to the marketplace. And so the overall picture here is that Northern Trust is one of these managers. We manage around $1.3 trillion of assets, and I'm responsible for around $88 billion on behalf of investors. And ultimately, my role within the organization is to make sure that as clients get exposure to the marketplace, they also have a way to integrate environmental pillar, social governance, and also broader environmental impact. So that's kind of very specific kind of type of strategies. There's different ways to do that, and I'm going to walk you through some strategies, but ultimately this is what you have to take into account. There is a way to invest that is also mindful of consideration that are environmentally friendly, but also focusing on broader governance issues. So, what do we mean by responsible investing or sustainable investing? Some of you may be familiar with an organization called the UNPRI. So the UNPRI is the United Nations Principle for Responsible Investment. It's an organization backed by the UN that was set up back in 2006 with a role to actually foster the integration of what we call environmental, social, and governance pillars. Now, I think it's very important to mention such organization because ultimately what you see on the slide here is the relevance of the definition that for the long-term health of the market as a whole, one has to take into consideration environmental consideration, social and governance factors. Now, most of the people think that you need to make money during the day and give away at night, but ultimately here, the definition from the PRI highlights the fact that the market health is actually based on integration of these underlying factors to make sure that we get a better society ultimately, but also better investment returns. So how do we look at it as an asset manager? Well, our goal is to actually provide investors with market exposure. You may be familiar with green bonds, you may be familiar with having equity exposure. So our role as an asset manager is to take analytics and to basically inform and invest on behalf of your stakeholders. So you could be a large pension, you could be a central banks, a sovereign wealth funds. Ultimately, each of you will have very definite performance expectations. And so what we do is that we are accounting for your expectation in building the right portfolios. So my role within the organization is to take your views and build a portfolio that is resilient and also focusing on a transition to a low carbon economy. And kind of walk you through what it means by that. So if you think about oil and gas companies today, and if you open your Bloomberg terminal, you look at the share price of BP or Chevron and others, the share price is telling you a couple of things, right? One of them is the view that basically valuation is embedded and this company will be able to continue to grow over the longer run. That's one way to think about it. But ultimately for oil and gas company, what it tells you is that the ability of these companies to extract oil from the ground with the same approach is actually already priced in. Now, the thing that is actually not really priced in is the fact that if you have a change of regulation or a disruptive technology, the way this company is valued will be completely different. And the notion of stranded assets is actually capturing that element that a lot of the project will become stranded as we transition to lower carbon economy and as regulation is not allowing companies to actually exercise the same way of extracting oil. And for me, that's a very important part of the conversation. Transition and policy risk is actually, alongside physical risk, the major change that oil and gas company will experience over the next few years. And therefore, one has to be very worried about the notion of stranded assets and the fact that companies won't be able to actually use the same project in the same areas and with the same technology. So I'll kind of provide you with some key information about the market trends and what we tend to see ultimately. Bringing back on your points that we heard earlier, there is actually an ask for greener exposure to the market, meaning renewables are actually growing at the fastest rate. And if you think about today, even in a market like the US, renewables are actually the area where you see the highest level of growth and employment. Now, if you look at your Twitter account, you might see different tweets from a certain type of views, but ultimately, this is the reality on the ground. Jobs are being created in the field of renewables in the United States, and it's actually one of the fastest growing fields across the board in the US from an employment standpoint. Another part is actually the fact that the ESG market, so environmental, social, and governance, has been growing at a CAGR around 20% over the past, call it 10 years. So faster than the standard asset management industry, renewable or sustainable investing is growing actually at a greater rate. So it's not a niche market, it is becoming a mainstream market that actually growing and creating a lot of opportunities. So what are the main drivers? Why do I think it's actually a market that is here to stay? Well, there was a couple of markers that I've highlighted in the slide here. We already spoke about policy and regulation. My view is that that's the hardest part to predict, because you will have more and more regulation. We've seen the French government moving after the COP21 into putting a lower transition where one has to account for climate scenarios and climate change risk in their portfolios. That was actually a change in regulation in itself. In other markets, especially in the Nordic region, we tend to see similar regulation coming along, and I think that's going to be a critical part of how we think about investing going forward. The other items that we have on the slide here are pertaining to risk and opportunities, aligning best practices, but also what investors are asking to the end companies. And I'll give you a couple of markers to think about. If you look at the concept of owning shares and becoming an active owner, if you have a portfolio today, ultimately you are entitled to exercise your voting rights. Well, last year alone, the highest level of ballots were related to climate-related issues. And we've seen more and more investors demanding more from their companies, challenging the way they account for climate change risk, and challenging also CEOs and CIOs of major investment listed companies. So for me, that's a very important point, that having your voice at the table, engaging with companies, is a tool that is actually allowing best practices to becoming more effective and therefore becoming part of the toolkit for investors. So that's something that one has to note as well. There's two other elements that I think are very important that explain why I think it's here to stay. First of all, we are noticing nowadays the biggest shift of money from one generation to another. So from the baby boomers to the millennials, we are noticing today the largest transfer of wealth that ever happened. And in the next decade, we're likely to see around $30 trillion moving from one hand to another. So what does it matter? Well, ultimately, it does matter because millennials tend to have a different approach of investing, but also their belief in what they are actually interested with is a different ethos as far as the relationship with the renewables and the way we need to think about the world more globally. First of all, the world is way more integrated, but ultimately, they also are more savvy to integrate renewables in their investment themselves. So for me, that's a very interesting marker, is that once millennials are actually becoming more and more part of the workforce, the way they invest, the way they select projects will also embrace renewables and be part of the broader transition as well. Okay, so that's what I refer as being kind of more transition linked to demographic. So every year, my team and I are sitting down around December time and thinking about the trends ahead of us. And these are the trends that we've highlighted at the beginning of the year, climate change being one of them, scarcity of resources when you think about water scarcity, and the other part is population dynamics. So I already covered the population part and climate change. The other part I'd like to mention is actually scarcity of resources. And I know we talk about oil and gas, but ultimately when you think about water, oil and gas industry is actually very savvy of the usage of water. And there is a shortage of water around the world, so therefore it actually exercises greater pressure on oil and gas companies to be very mindful of the way they actually use the cooling technique when it comes to their own operations, but also where they select project and where they are close to natural sources of water. And we think that actually water is likely to become one of the major critical issue going forward as we think about the pressure that you see in the marketplace. And one has to think about water as actually being a very important part of lowering your impact when you think about your own operation. So that's something that I'm eager to mention as well. The other trends are linked to the Sustainable Development Goals that are very aspirational, but today you have practical ways to do that at a portfolio level. We have portfolios that are accounting for what we call the SDGs and allowing investors to build portfolios that are accounting for the SDGs and providing a line of through the revenue line that is actually impacting, alleviating poverty, improving education, but also focusing on climate as well. Now, so what do we mean by building these portfolios and how it is in practice? So in the last few minutes, what I would like to do is give you a more practical example of how does it work ultimately when you build an investment portfolio. So in the mosaic house you have here, you have a range of topics that are part of what I look into when I build portfolios. I will focus only on the E pillar, environmental pillar, and mention sustainable resources, clean technology, climate change, and low carbon. And they're all interlinked and interrelated, but they're all very different in many ways when I build a portfolio and we're looking to analytics. So let me kind of walk you through an example here and explain the way I can do and build a portfolio. So ultimately, the most naive approach is to think about exposure and trying to avoid the worst. So that's what you hear a lot about, divesting from oil and gas companies or from fossil fuel as a way to tackle climate change risk. As a practitioner, I strongly believe that this is probably not the best way to actually tackle the problem. Because if you divest from a sector, ultimately you don't have a voice and you cannot change behaviors. And we've seen the divestment campaign being a strong movement across US campuses and other part of large asset owners worried about the headline risk. But I don't think that this is a more effective way to transition to low carbon economy because you don't have a voice by not having shares. There is other ways that are more meaningful and more impactful is actually to focus on what we call best-in-class strategy. This is the gray box in my slide here, where you are actually exhibiting or, let's say, enforcing best best behaviors and pushing companies to provide lower carbon exposure and also focus on renewables. The other areas are thematic investing. Think about a green fund or any very thematic fund. This is also part of the ecosystem and way more impactful across the board. So in the slide here, my view is that best-in-class low carbon strategies are actually the best way to go forward, and also by combining them with thematic portfolios as a complementary approach. Okay? Now, how do I build a portfolio? Well, first of all, I need a lot of data. As a alumni of ESCP, what I've learned is that data does matter, and ultimately, as you build a portfolio, what I'm relying on is a lot of information, AI, information from the likes of MSCI Analytics, Swiss Analytics, that provides a lot of information around carbon footprint or true cost and others. Then I actually use all the analytics at the company level, and then I run an optimizer. Basically, as you're looking at your utility function, I'm trying to invest at a higher point of basically lower risk and higher performance to get exposure to the marketplace. And the last part is basically providing a portfolio to my investors with a sense of what is a tracking error versus a broader benchmark. It could be MSCI World or any other benchmark you have in mind. So that's kind of the way I can build portfolios in my own practice. Now, I would like to conclude in the next few seconds. I have like to give you an overall view of some of what we call best-in-class ESG benchmark. And what I'd like you to focus on is a lot of numbers in the slide here, is to look at the 1-year, 5-year, and 3-year numbers and the bold characters here that represent the highest performance of benchmarks. SRI stands for socially responsible investing, and ESG are basically the equivalent with more best-in-class. As you could see on the slide is that ESG and SRI strategies tend to outperform a standard market cap benchmark. So what it means is that by selecting a strategy focusing on renewables or focusing on other ESG factors, one doesn't have to leave performance at the table. So ultimately, the main message for me and the main takeaway is that you can do good and do well by the same token by integrating ESG factors in your portfolio. And my take is that this is the way forward, and the oil and gas companies has a clear role to play in that overall ecosystem. I thank you for your attention.
Thank you, Mamadou. Perfect timing. If you can join us here for a couple of questions. If we have any questions from the audience to start with. Anybody, if you have any question for our speakers? We have one. What is your take for some of the oil and gas majors now, one after the other, kind of announcing that they are going to renewables, obviously? I mean, it's not an issue of actually replacing their own reserves. I mean, they have that ability. They have had that ability for years. I don't think it's a matter of scarcity of the resource in this case, but it's a matter of strategy. And I think how much is the strategy of this kind of these firms is affected from fund managers like yourself, from people that are looking at them and analysts that are scrutinizing their moves?
So the way I look at these companies for me is like the way I will look at every sector, right? So every sector represents a set of opportunities, and I'm trying to find what are the best practices. And you tend to see that now the best practices for oil and gas companies is to embrace renewables to a greater extent. We've seen some early movers that are actually showcasing the fact that it is effective as a strategy. But the other part that is actually very critical is the fact that investors are asking for more exposure to renewables. Now, if you think about the energy mix, I don't think that oil and gas or even the use of fossil fuel will disappear overnight. It has to be a transition. And ultimately, the big players, given the initial investment, are likely to be the one that will benefit from the transition. Given the high barrier to entry, it is very hard for a new player to just come and be effective and provide exposure to the market globally. So the players of today will have to transition and continue to do that alongside their energy mix. But for me, it's actually both an imperative from an investment standpoint. It is demanded by investors, and also it makes sense from a business standpoint.
Yes, Patrick, we have a question here. Yeah.
Well, it's in the oil and gas companies, they have to be very generous with the shareholders because shareholders are demanding dividends, as you know. And they have a high level of debt, and sometimes they have to borrow money to pay dividends. Don't you think that it means, because it's a bit surprising, because it's also a field where you need a lot of cash to invest. So one explanation for this might be the fact that shareholders don't want to take the risk anymore, and they transfer the risk to lenders. What do you think about this? Because that would mean that shareholders are slowly getting out of the oil and gas market because they feel that that's not the right place to be for all the reasons you have mentioned. And then the risk is transferred slowly to the debt market, because there is so much money which you can raise, for cheap debt. So what's your view on this?
Sure. So I'll probably have more nuanced views as far as what I see in terms of the shelters versus basically the bondholders and how the mix is playing. Ultimately, if you think about very dedicated debt that are focusing on climate change risk, it's only pertain to the green bond markets, and that market represents hundreds of billions today versus the broader debt market. So it's still at a very infancy stage, and you only have a subset of corporation issuing green bonds versus supranationals, so development banks. So it's still a very small and niche market. So for now, it's still an equity player, meaning shareholders in long term are still getting exposure to oil and gas until you have actually a better mix of bonds option that might be applicable in the focusing specifically on climate resilience and green bonds. So my view is that the notion of long-termism, and you think about oil and gas projects are actually long run, you have to think about how shareholders can change their behaviors and enforcing more pressure on companies to improve their practices.
Okay. Jeff, I don't know if you have anything to add.
Yeah, I mean, that's an interesting phenomenon, is that the sort of rise of debt. Now, obviously, it's very much unevenly distributed between players, but something like fracking, there's now something like, some estimates put $1 trillion of debt, which is an awful lot of money. And with, we know partially, as I said earlier, investors have become a lot less discerning. At some stage, the QE effect will wind down, and then things will become very unpredictable.
Okay, if we don't have any other question, we can move to our next panel. Thank you very much. Thank you.